What's up, DSLF gang? If you're watching this video, then you're probably noticing that, yeah, the background's slightly different. Well, it's actually because I'm in a hotel right now for my workplace. But yet, I still wanted to get this video done for you guys because this is going to be one of my favorite videos. Trust me. If you guys are here because of the title, then yeah, you must be interested in finding some good stocks. In this video, guys, I'm going to literally be going through step by step how I find the good stocks that I find through the screening process, guys. I'm going to literally be going with you guys on the computer, showing you guys what exactly I do. Yeah, oh boy. Let's get into it.
You know what you're watching. DS Learning Finance. Whoa.
First and foremost, guys, yeah, when you're looking for stock, what you need to establish is what type of stock you're looking for. Now, for me personally, what I like to look for is breakout stocks. Stocks that are breaking out from a lower division to a higher upper division. And that is ranked according to the market cap. So particularly, I would avoid stocks personally that are already in the FTSE 100 because pretty much you can say a majority of them have already reached their ceiling. They've already reached the growth, the maximum growth, well, thereabout, they can expect to obtain with that stock. So I particularly look for stocks that are starting to peak out and starting to really expand. That's the stocks that I look for. So with that said, what we need to do is go to a stock screener. I personally like to go straight to the source, so the London Stock Exchange is where I would go. So London Stock Screener, they have a screener. It's okay, it's not that great, but it's all right, it'll do the job. Yeah, so click on it, London Stock Exchange Screener, LSC. This is where obviously all the stocks are placed. Well, the legalized stocks. You have other stock markets like AIMS market, which is unregulated, but I like to stick to regulated stocks because you don't want to find that you're putting your money in some like drug cartel company that's like pretending to be a pharmaceutical company, but it's like drugs. Yeah, so you can see why I put my money in established stocks basically. So as I mentioned, obviously I'm not looking to invest in stocks that are in the FTSE 100, but I'll be looking to invest in stocks that are getting there. So let's say, for example, the FTSE 250. That's what I would look at, or the FTSE 350 maybe, or basically all the ones below, the small caps, FTSE small caps, that's another one. But as you go down and down the pecking order, it becomes harder to really define what sort of stock you're looking for, simply because there's more of it. But we're going to stick for this task to the FTSE 250, let's say. So I've clicked that tab. Now what do I look at? There are four main things. It's not just these four things that I look at, guys, but there are really four main things that I really hone in on during this preliminary process. And the first one is the market cap, which I hinted at, and that's because obviously it relates to the type of division of stocks that you're investing in. There's also the PE ratio that I like to look at. This tells you how overvalued the stock is. There's the revenue, which is obviously simple. Everyone knows how much money does a company make on a yearly basis. And then there's finally operating profit. And this is slightly different. There's loads of profits available, but operating profit basically is the profit that a company obtains before it's had its expenses deducted, before it's had any interest deductions added on it as well. That's what operating profit is. So these four things, guys, I really like to focus on. Cool. So now we're going to set the targets. What are my actual filters? Well, if it's coming to the market cap, like I mentioned before, I don't look at investing in FTSE 100 companies. I look at investing in companies that are getting there. So they might be getting from the 350 to the 250, but in this case, it's from the 250 to the 100. So straight away, that tells me what sort of region in terms of stocks I need to look for. And for you to effectively qualify for the FTSE 100, you actually need a market cap of 4.6 million. I'm sorry, 4.6 billion. Let's get that straight, billion pounds. So that effectively means I can set my market cap. So my market cap now becomes 3,000 million, it's a million, to, I would say, roughly 4,000 million. I don't want to go any lower than 3,000 because it's probably got a longer while more to go before it actually reaches that sort of range. And I don't want to go any more above 4,000 because chances are it's already going into the FTSE 100 and everyone's already gotten on the bandwagon. So that's why I literally like to stay in between that range, because it gives me a sort of gauge. Okay, maybe I can assess these stocks. Cool. The revenue, I don't really like to put a restriction on it, and it's because I use it typically to compare stocks. Whenever I've got like two stocks that really look good, I would look at the revenue to assess its profitability. So we'll skip that one, but we still want to see it. Cool. The PE ratio. The PE ratio is another restriction I like to put on. So as I mentioned previously, PE ratio assesses how overvalued a stock is or undervalued. So for me, I don't like to invest in stocks with a higher PE ratio than 30. So the maximum I'll put on that will be 30. To be quite honest with you, 20 to 30, that's already overvalued to me. But I still say 30 because you can still get some stocks that still have a lot of like room to grow. So I don't necessarily cap it there, but it's just one thing to note. In terms of PE ratio, why this is really important is because you don't want to invest in a stock that is massively overvalued. Why? Because you're going to find it harder to make a profit on that stock because it's already overvalued. See, if you bought undervalued stock, you've got much more growth, you've got much more margin to make profit from. And finally, the last one is the operating profit. Now, this is my secret, guys. I'm really letting you guys in on this one. Why is this my secret? Because it relates to your market cap. And why does it relate to your market cap? Because it depends on the type of stock that you're investing in. So this is the sort of structure I want you guys to adopt when you're looking for stocks, because the operating profit relates to the market cap. Now, why is the market cap important? For me, a lot of people see the market cap as the formula, i.e. share price multiplied by a number of stocks. I don't see it as that. I see it as literally, if I was a billionaire one day, don't say anything, one day, if I was a billionaire, I would be able to buy this stock for a certain price, and that price is the market cap. See, that's how I see it. Why? Because when it comes to the operating profit, I can then determine how much my operating profit should be as a very bare minimum. So a good rule of thumb I like to adopt is 10 to 15 years investment payback period. So after 10 to 15 years, I know that, cool, this investment, i.e. the market cap that I bought this stock from magically, needs to have paid itself back in its profit, operating profit. Now that's good, because that basically equates to 7% to 10% profit compared to the market cap each year. So as a very bare minimum, you know that this operating profit has to be at least 7 to 10% of what the market cap is. And that's why I really like to use the market cap as well. Cool. So 7% of 3,000 million, which is 3 billion, is roughly 210 million. So I would set that as a minimum requirement, because that then tells me, okay, this investment, yeah, it's kind of worthwhile investing in, because the payback period is quite short, and yeah, I know that the company's profitable. Cool. So those are all my criteria, and then what do? I click search. Okay, search. There we go. Yeah. I apologize if you guys hear some footsteps and some banging. It's because some people near me, they want to do some stampede early in the morning. Elephants just walking around. I decide to be so heavy-footed, I don't know why. But anyway, back on topic. This is what I find, guys. This is what I find after I click search. So it's important to note that some stocks you just like probably won't fit that criteria. So for example, Spectris, straight off the bat I can tell it's not profitable enough for what I like to do. But you've got other stocks that may be slightly under it, but I'd be more willing to accept it, more inclined to. For example, Electro Comps, yes, it's the operating profit is less than They're doing Stampede again. Yes, the operating profit is less than 210 million, but it's thereabout-ish, and I'll be more willing to accept that. You do have more profitable companies further down the pecking order. Like I know Wizz Air looks really profitable. That might be something I'm looking at. But the important part is this just opens the door, guys. This just limits what you need to really hone in on. The research doesn't stop here, guys. It's important to stress that it doesn't, because what you now have to do is look at the financial documents, look at the income statement, the balance sheets, the cash flow statement, and decide from there. But even after that, you've then got to look at the reports, guys, as well. So actually find out what the company is doing, what its future investment plans are. Does it correlate with what you agree with? Does it correlate with your ethics? Can you see a vision for it? These are the sort of questions you guys need to be answering and finding out as you dive in deep into these stocks. It just doesn't stop there, guys. I don't take one of these stocks and run with the wind with it. No. I literally narrow down the research to these stocks, and then I would go from there. Also, another thing to take note of is the last close date. And basically what that is the last price before that stock closed for the operating working day. Why is that important? Because you'll find that when you like really dive in deep, it can take sometimes days to actually find a stock that you're happy with, that you've done a deep analysis with and you're happy with it. So by that time, the share price could have changed dramatically. Like, no, I've been burnt that way. I've learnt my lesson. Yeah, take note of the share price before you like dive in deep, because then it allows you to assess, okay, have these few days overvalued this stock? And if not, let me just wait a few more days for it to come back down to when I was initially looking at it. So yeah, take note of that as well. It's your favorite YouTuber, guys, Dami Solara. I talk about stock market investments, property investments, financial management, to giving you guys that consistent content, you know, before you guys can go about doing whatever you're going to do for the rest of the day. Say with me, what? Like, subscribe, and share. People, DS Learning Finance. Whoa. Bye, guys.
Whoa.